Are you worried about inflation in 2024? If you are, you're not alone. Inflation. It's a word that can send chills down the spine of even the most seasoned investors. But what exactly is it? Essentially, inflation is the rate at which the general level of prices for goods and services is rising. It's like a silent thief nibbling away at the value of your money. Imagine this: you've stacked away a tidy sum of cash under your mattress. A year later, you pull it out expecting to buy the same amount of stuff as before. But surprise, prices have gone up. Your money can't stretch as far. That's inflation in action, folks. It's a global economic phenomenon, and no country is immune. Now, why should you, as an investor, be concerned about inflation? Here's why. Inflation can erode your purchasing power. It means that the money you've worked so hard to save and invest today could buy less in the future. It's like running on a treadmill that's slowly speeding up. You have to run faster just to stay in the same place. But it's not just about your savings. Inflation can also impact your investments. Let's say you've invested in bonds that offer a fixed interest rate. If inflation rises, the real return on your investment could diminish or even turn negative. That's not a pleasant thought, is it? Inflation is a tricky beast. It's unpredictable and can be influenced by a variety of factors, from government policies and global events to supply chain disruptions and natural disasters. So, as we look towards 2024, it's understandable if you're feeling a bit anxious about the specter of rising inflation. But fear not, there are ways to beat inflation. Ready to find out how? Before we dive into beating inflation, it's important to understand how it affects your money. So, let's take a little journey through the land of economics. Picture this: you've just been given a shiny, crisp $100 bill. Feels good, right? Now let's say you decide to tuck it under your mattress for safekeeping, instead of spending it right away. Fast forward a year, you pull out that same $100 bill. It's still crisp, still shiny, but here's the catch. It doesn't quite buy you as much as it would have a year ago. This, my friends, is the magic, or rather the mischief, of inflation. Inflation is like a crafty little pickpocket, silently and subtly snatching away the value of your money over time. This phenomenon is known as the depreciating purchasing power of money. It's a fancy term for a simple concept. As prices rise, each dollar you own buys a smaller percentage of a good or service. Let's break it down with a relatable example. Imagine you're a fan of a certain famous coffee chain, and your go-to order costs $5 today. If the inflation rate is 2% per year, that same cup of Joe will cost you $5.10 next year. Doesn't sound like much, right? But multiply that by the number of cups you buy in a year, and you'll start to see the bigger picture. But hold on, it's not just your coffee that's affected. Inflation also gnaws away at your savings. That's right, the money you've been squirreling away for a rainy day, or for retirement, or that dream vacation, is slowly losing its value if it's not growing at a rate that's at least keeping up with inflation. This is known as the erosion of savings. So inflation, this seemingly invisible force, can have a tangible impact on your financial health. It's like a slow leak in your wallet, draining away the value of your hard-earned money. Now that you understand the basics, it's time to strategize. One of the most effective ways to beat inflation is by investing in stocks. Now, you might be wondering, why stocks? Well, here's the simple answer. Companies usually have the ability to adjust their prices in response to inflation. As a result, their revenues and profits may increase, which can lead to higher stock prices. Think of it as a seesaw. On one side, you have inflation, trying to push your purchasing power down. On the other side, you have the potential returns from stocks, pushing back against inflation. Over the long run, stocks have historically outperformed other investments, making them a powerful tool in your fight against inflation. But there's a catch. Investing in stocks isn't like a walk in the park. It comes with its own set of risks. The value of stocks can fluctuate, sometimes dramatically, so you need to be prepared for some bumps along the way. But remember, while stocks can provide higher returns, they also come with risks. Another excellent strategy to beat inflation is investing in real estate. In the game of financial chess, real estate is the queen, boasting both defensive and offensive capabilities. When inflation rears its ugly head, real estate often shines as a safe haven. But why is that? Well, let's break it down. Firstly, real estate is a tangible asset. And while it's not immune to market fluctuations, it's less volatile than, say, stocks. This tangibility offers a certain level of protection against the whims of the economy. Secondly, real estate values tend to rise over time. This is partly due to inflation itself. As the cost of materials and labor increase, so does the value of the property. This is known as capital appreciation, and it's one way your investment can grow. But it's not just about the property's value. Real estate also offers the potential for rental income. As prices rise due to inflation, landlords typically increase the rent. This means as an investor, you could potentially earn an inflation-beating income stream. However, it's important to note that real estate isn't a one-size-fits-all solution. It's not just about buying a property and waiting for the money to roll in. You need to consider factors like location, property type, and market trends. For instance, investing in a rental property in a city with a growing population could provide a steady income. On the other hand, a vacation home in a popular tourist destination might offer higher rental rates, but with the risk of seasonal fluctuations. Moreover, real estate investment isn't without its challenges. It requires ongoing management and maintenance, and there can be legal and financial complexities to navigate. So if you're considering this route, it's crucial to do your homework. In summary, real estate can be a powerful weapon in your arsenal against inflation. It offers the potential for capital appreciation and a steady stream of income. But remember, every investment carries risk. So take the time to understand the market, evaluate your options, and plan strategically. Real estate can be a profitable venture, but it requires careful planning and research. Our final strategy to beat inflation is diversification. You might have heard this term before, but what does it really mean? Diversification is the financial equivalent of not putting all your eggs in one basket. It's about spreading your investments across a range of different assets and sectors. Why is this important, you ask? Well, let's imagine you've invested all your money in one particular company. If that company goes under, you lose everything. But if you've spread your money across 20 different companies, the risk is significantly reduced. If one company fails, you still have 19 others to fall back on. Now let's apply this to inflation. Inflation erodes the value of money. So if all your money is in cash, you're going to feel the pinch. But if your money is spread out across different assets like stocks, real estate, and bonds, you're less likely to feel the full force of inflation. Different asset classes react differently to inflation. For instance, stocks can be a hedge against inflation because companies can raise prices to cover increased costs. Real estate can also be a good hedge, as property prices and rental income often rise with inflation. On the other hand, bonds can be negatively affected by inflation, as the fixed interest payments become less valuable in real terms. But here's the key. It's not just about having different types of assets. It's also about having assets in different sectors and regions. This way, if inflation hits one particular sector or region hard, your other investments can help cushion the blow. So how do you go about diversifying? Start by identifying your investment goals and risk tolerance. Then, research different asset classes, sectors, and regions. Consider getting professional advice if you're unsure. And remember, diversification isn't a one-time thing. You need to regularly review and adjust your portfolio to ensure it remains diversified. In essence, diversification is a safety net. It doesn't guarantee you won't lose money, but it can help spread the risk. And in an inflationary environment, spreading the risk is exactly what you want to do. Diversification can help protect your investments from the negative effects of inflation. Beating inflation may seem like a daunting task, but with the right strategies, it's entirely possible. The key is to stay ahead of the curve, to be active rather than reactive. Remember, inflation is not an insurmountable enemy, but a financial phenomenon that can be managed with knowledge, planning, and investment savvy. Our journey through understanding inflation, investing in stocks, tapping into real estate, and diversifying our portfolio has taught us the importance of keeping an eye on economic trends and making strategic decisions. The year 2024 brings its own challenges but also opportunities. As we step into this new year, let's carry forward these lessons. Let's stay vigilant, invest wisely, and most importantly, keep learning. The road to financial security is a marathon, not a sprint. And remember, you're not alone in this journey. Be sure to like, subscribe, and turn on the bell for all notifications from Money Masters. Until next time, keep mastering your money.